All right, so let's dive right into this deep dive that you requested about intelligent investing. You wanted to look at Benjamin Graham's The Intelligent Investor. So
That's the one.
that's exactly what we're going to be doing today. And we've got some good stuff here. We've got excerpts directly from the book itself, and
Nice.
then also some interesting commentary from Jason Zweig, who edited a more recent edition. Our mission is to really break down these core principles of what it means to invest intelligently.
Right.
We're going to be talking about how to think about things like risk and reward,
The
and,
fun stuff.
well, that's part of the fun stuff. But most importantly, how to avoid some of those classic investing pitfalls.
Yes. So, a lot of people, when they think about investing, they think about getting rich quick.
Hmm.
And that's kind of where Graham really flips the script. He's really all about minimizing your chances of losing big.
That's a nice, refreshing take, especially in a world where
Absolutely.
it feels like everyone's always chasing the next big thing.
Mhm.
So how does Graham define intelligent investing? Like, what does that even mean?
He boils it down to three key things. Number one, you got to do your homework, thorough analysis.
Mhm.
Number two, you need to protect yourself from those big losses. And number three, aim for adequate, not extraordinary returns.
Whoa. Did you catch that?
That's it.
The father of value investing is actually telling us not to try to beat the market.
Right. Kind of interesting.
Okay, I need to hear more about this.
Yeah, so it all starts with really understanding the difference between investing and speculation.
Oh, yes. The classic investing versus gambling debate.
Exactly. So for Graham, investing is all about digging deep. You're looking at the company's financials, their business model, making sure you're not overpaying for that piece of the pie. Speculation, on the other hand, is more about trying to guess what the market's going to do next. It's a dangerous game, especially when emotions are running high, as they often do in the market.
And I bet Graham has some pretty compelling stories about how speculation can go wrong.
Oh, absolutely. He uses some pretty vivid examples from the 1990s tech bubble. I don't know if you remember those. I think they called them stocks on speed. Some research from Sanford Bernstein actually showed that some tech stocks in 1999 were being traded after like an average of only a few days of ownership.
Oh, wow.
So that's pure speculation, not investing.
That's crazy.
Yeah, and it's not just everyday investors getting swept up in this hype either. Even celebrities like Barbara Streisand, they were buying into the dot-com craze.
Well, that's a good reminder that even the smartest people can fall prey
Right.
to this market mania.
Oh, yeah, absolutely. And that's why Graham really stresses the importance of patience and discipline. Investing is a marathon, not a sprint.
Like that old saying, slow and steady wins the race.
Exactly. And Graham wasn't just theorizing about this either. He shared this really interesting story about Sir Isaac Newton, the brilliant physicist. He actually lost a fortune in the South Sea bubble.
Oh.
So, if a genius like Newton could get caught up in the frenzy, it's definitely a cautionary tale for all of us.
Ouch.
Mm-hmm.
That's gotta hurt, even for a genius.
Mm.
So how do we avoid becoming a cautionary tale ourselves? Where do we even start?
Well, Zweig's commentary includes what he calls a chronicle of calamity, which is basically a rundown of recent market crashes and scandals.
Oh, fun.
Yeah, and it really highlights the need for emotional resilience in this game. You need a strategy to kind of help you tune out all that noise.
So what's the secret? How do we actually stay disciplined when the market's like going completely haywire?
Well, one popular technique is dollar cost averaging. It's where you consistently invest small amounts over time, regardless of what the market's doing. Think of it like the Motley Fool, for example. Their whole investment strategy is built around consistency, taking the emotion out of it, and they've had some incredible success with it.
Yeah, it makes a lot of sense. But speaking of things that can throw us off course, we got to talk about inflation. Graham wrote The Intelligent Investor in the early 1970s when interest rates were just through the roof. And he wasn't exactly optimistic about stocks as an inflation hedge, was he?
Not really, no. He even talks about this concept of the money illusion. Investors get excited when they see stock prices going up, but they kind of forget that inflation is eating away at their returns.
It's all relative.
It can be deceiving. Like, for example, between 1973 and 1982, inflation was so high that it wiped out a huge portion of investors' returns.
Oh, wow. That's a scary thought.
It is.
So what do we do about inflation when we're planning our investments?
Well, it's important to remember that Graham's view on stocks as an inflation hedge was formed during a very specific period, right? Like he didn't have access to things we do today, like REITs, which
Right.
are real estate investment trusts, or TIPS, which are Treasury inflation-protected securities.
Heard of those.
Yeah, so these are assets that can actually help you stay ahead of those rising prices.
So it sounds like it's important to have a mix of different assets in your portfolio, not just stocks.
Exactly. Diversification is key, and considering the potential impact of inflation is a crucial part of that.
Okay, so now that we've laid some groundwork, let's talk about the actual nitty-gritty of building a portfolio. Graham outlines two approaches. You got the defensive investor and the enterprising investor.
Right. And the defensive investor, also known as the passive investor, is really the sweet spot for most people.
Okay,
It's about minimizing risk and getting decent returns without needing to spend all of your time obsessing over the market.
gotcha. So what would a defensive portfolio actually look like?
Graham suggests keeping it simple with a 50-50 split between bonds and stocks.
Okay,
For the stock portion, you want at least 10 different companies, but no more than 30. And here's the kicker. He recommends sticking to those large, well-established companies with a long history of paying dividends.
interesting. So no chasing after those hot new startups?
Not in a defensive portfolio. It's all about stability and minimizing your chances of losing big.
Got it. But Graham also talks about this kind of intriguing strategy of investing in what he calls unpopular large companies.
Yes, he recommends looking for those companies that have temporarily fallen out of favor with the market.
Seems counterintuitive.
It does.
Why would you want to buy something that's unpopular?
Well, think about it this way. These large companies, they usually have the resources to bounce back. And the market, it tends to overreact to bad news.
So you're basically looking for those hidden gems that the market has overlooked.
You could say that, yeah. And a study by Drexel and Company, covering the period from 1937 to 1969, showed that this approach could actually beat the market.
Wow.
Yeah.
Now that's what I call going against the grain. So how do you actually spot one of these potential comeback stories?
So Graham outlines two key tests. The first is what he calls the appraisal test. And you're basically trying to figure out if the company is selling for less than its true worth.
So you're looking for a company that's on sale.
In a way, yes. And then there's what he calls the earnings and price history test. You're looking for those companies with a solid track record of strong earnings and stable or rising prices, even when the market is taking a beating.
So consistency and resilience are key.
Exactly. And he gives a couple of examples from the early 1970s, General Motors and Standard Oil of California. Both companies met his criteria for bargain issues. And you know what? They ended up doing quite well.
Nice. Okay, so we've got some strategies now for finding those potentially undervalued stocks. But I'm guessing there are also some things we need to avoid.
You bet. And one of Graham's biggest warnings is about investing in new issues, especially in those overheated markets where everyone's chasing the next big thing.
Like all those tech IPOs in the late 90s.
Exactly. He points out that new issues are inherently risky. There's no track record to look at. And prices tend to be inflated in what he calls a speculative atmosphere.
Gotcha. So what other traps should we be on the lookout for?
Well, he also cautions against investing in what he called second grade or lower grade bonds, what we now call junk bonds, because they're considered higher risk. He also warns against excessive trading or what's called market timing.
Trying to time the market, buy low, sell hot.
Exactly. Research from Duke University actually shows that it's incredibly difficult to predict market movements consistently, even for the professionals.
Yeah, makes sense.
So the message here is buy and hold. Don't try to get too clever.
Don't outsmart yourself.
Right. And finally, never forget the importance of diversification. Putting all your eggs in one basket, even if it seems like a sure thing, is incredibly risky.
Yeah, that makes a lot of sense. So we've covered a lot of ground here. We've talked about defining what intelligent investing actually means, understanding the impact of inflation, even how to spot those bargain issues. What's like the one key takeaway you want our listener to walk away with from all of this?
I think the most important thing to remember is that intelligent investing is a long game. It's about having the discipline to stick to those sound principles, even when the market is going crazy.
And resisting the urge to chase after those shiny new,
Oh, yeah.
tempting distractions.
Absolutely. And that's one of the things that makes Graham's book so valuable. It's really this timeless guide to navigating the ups and downs of the market.
And what really stood out to me was Graham's warning about those high-yield second-grade bonds, the junk bonds.
Yeah.
His advice just feels as relevant today as it was back then.
Oh, absolutely. Just look at the WorldCom bond debacle back in the early 2000s. Investors were chasing those high yields. They ended up losing a fortune when that company went belly up.
Yeah, that's a sobering reminder that there really are no shortcuts in investing.
No. Thorough analysis and risk management are key.
You know what really struck me about Graham's approach? It's not just about numbers and strategies.
Yeah, it's almost like a philosophy of investing.
Totally.
Right. And a big part of that is understanding yourself.
That's so true. He
Yeah.
even says the investor's chief problem and even his worst enemy is likely to be himself.
It's such a powerful statement because, we all have those biases and tendencies that can really trip us up.
Absolutely. Like when the market's going crazy, are you the type to panic and sell everything, or do you get FOMO and buy whatever's hot without even thinking it through?
Right. And recognizing those patterns is crucial. That self-awareness is what helps you make those rational decisions instead of those emotional ones, which is a core part of Graham's approach, right?
Yeah, absolutely. And you know what's funny is even though Graham was writing decades ago, his warnings about speculation feel, I don't know, more relevant than ever, especially with all these like get rich quick schemes floating around today.
It's like those formula investing fads that were popular in the late 90s.
Eh.
Remember that whole cash in on the calendar strategy?
Where you buy small stocks in January and then hold them for the year.
Exactly. It sounds so simple and tempting, but the market, rarely plays by those rules.
Because real world investing is so much more nuanced.
Right. There was also that dogs of the Dow approach where you picked the stocks with the highest dividend yields. Again, it sounds clever, but the results were often inconsistent.
Yeah. It's like trying to outsmart a system with like millions of moving parts.
Exactly. The market is incredibly complex. Trying to predict its every move is almost impossible.
So instead of chasing those like quick wins, what does Graham suggest we actually do?
He focuses on value, finding those companies that are worth more than their current stock price.
So it's about doing your research and actually like understanding what you're buying.
Absolutely. You're analyzing the company's financials, their competitive landscape, their long-term prospects. It's about making those informed decisions based on facts, not hype.
And this is where that strategy of investing in unpopular large companies comes in.
Exactly. Graham suggests looking for those big companies that have temporarily fallen out of favor.
So you're basically looking for those companies that everyone else is selling.
In a sense, yeah. The idea is that these companies often have the resources to turn things around, and the market just tends to overreact to negative news.
So you're betting on a comeback story?
You could say that. And remember that study by Drexel and Company we talked about earlier, the one that looked at the period from 1937 to 1969?
The one that showed that investing in unpopular large companies could actually beat the market.
That's the one. It's a classic example of contrarian investing going against the herd mentality.
I love that. So let's talk about how to actually identify these bargain issues. Graham lays out a couple of key tests, right?
He does. The first is what he calls the appraisal test, essentially figuring out if a company is selling for less than its intrinsic value.
So it's about determining what a company is really worth.
Exactly. You look at their assets, their earnings, their future potential. A great example Graham gives is General Motors in 1971. The stock was so undervalued compared to the company's assets and earnings power that it was like a screaming bargain.
Okay, and what's the second test?
That's the earnings and price history test. You're looking for companies with a proven track record of strong earnings and stable or rising stock prices, even during tough times.
So consistency and resilience are key here.
Exactly. Another one of Graham's examples is Standard Oil of California in the early 1970s. They had this amazing history of steady earnings growth and dividend payments, making them a solid investment even in a shaky market.
Those are some great examples. It's amazing how Graham's principles still hold up today, even though he was writing decades ago.
It's because human nature doesn't change, right?
Right.
And neither do the fundamentals of investing. We still see those same patterns of fear and greed driving the market.
So even though we have all these new technologies and industries, the core principles of intelligent investing remain the same.
Exactly. Graham's book provides a timeless roadmap for navigating the complexities of the market and building wealth over the long term.
Speaking of things that haven't changed much, Graham's warnings about new issues are just as relevant today as they were back then, especially in those overheated markets.
Right. He was really wary of IPOs, wasn't he?
He was. He saw them as inherently risky because, there's no track record to go on, and there's always that potential for manipulation by underwriters. Plus, prices tend to get inflated in that speculative atmosphere he talks about.
Yeah, history has proven him right time and time again. Just look at the tech IPO craze in the late 90s and early 2000s. So many investors got caught up in the hype and lost big when those companies crashed.
It's like those speculative bubbles just keep coming back.
It's a testament to how powerful psychology is in the markets. People get swept up in the excitement and the fear of missing out, and they throw caution to the wind.
So what's the lesson here?
Be skeptical, do your research, and remember, investing isn't about getting rich overnight. It's about building wealth gradually and strategically with a margin of safety.
Which brings us to another important point Graham makes: avoiding emotional decision-making.
Right. He calls emotions the investor's worst enemy.
And it's so easy to get swept up in the market swings, right? When things are going up, you feel invincible, but when they crash, you panic and sell everything at a loss.
That's why having a solid investment philosophy and sticking to it is so crucial. And Graham's book provides a framework for doing just that.
It's like having a set of rules that you can follow even when your emotions are screaming at you to do something else.
Exactly. Discipline and patience are the hallmarks of a successful investor.
You know, I love how Graham uses like real-world examples to illustrate his points.
Yeah, it definitely makes those concepts more relatable.
Like his warning about second-grade bonds, what we now call junk bonds. He had some strong words about those.
And for good reason. You know, they might offer those high yields, but they also come with a lot of risk. Just look at what happened with WorldCom in the early 2000s. Investors who chased those juicy yields lost a lot of money when the company went under.
Yeah. It's a reminder that if something sounds too good to be true, it probably is.
Exactly. And that's why Graham emphasizes thorough analysis. Don't just follow the crowd or chase the latest hot stock. Do your homework. Understand what you're investing in.
Which brings us back to the importance of avoiding excessive trading or market timing. Graham was really adamant about that, wasn't he?
He was. He believed that trying to time the market was a fool's errand.
Yeah.
And research from Duke University backs that up. Even professional investors struggle to do it consistently.
So what's the alternative?
Focus on finding those undervalued companies that align with your investment goals and then hold on to them for the long haul. Let the power of compounding work its magic.
And diversification is key too, right?
Yeah. Absolutely. Don't put all your eggs in one basket, no matter how promising that one basket might seem. Spreading your investments across different asset classes helps to manage risk.
It's all about widening out those inevitable ups and downs in the market.
Exactly. And that brings us back to Graham's core definition of intelligent investing. It's not about getting rich quickly. It's about minimizing your risk of losing big and achieving adequate, not extraordinary, returns.
So it's a much more nuanced approach than what you often see in the financial media, which is obsessed with like hot stocks and predicting the market's next move.
Right. Graham's approach is more grounded and focused on the long term.
It's almost like a philosophy of life as much as it is a philosophy of investing.
That's a great way to put it. Graham's book is filled with wisdom about patience, discipline, and recognizing your own limitations. Those are qualities that serve you well in all aspects of life.
So as we wrap up this deep dive into the intelligent investor, what's the one thought you want to leave our listener with today?
I think it's this. Intelligent investing is a journey, not a destination. It's about continuously learning, adapting, and staying true to your principles.
Wise words.
Yeah.
And I think Graham would wholeheartedly agree. Thanks for joining me on this fascinating exploration of intelligent investing.
It's been my pleasure. And for our listener, remember, knowledge is power. Keep learning, keep exploring, and keep those investment goals in sight.
You know, it's fascinating how relevant Graham's book still feels today, even though it was written like, decades ago.
Yeah. It really is a testament to how deeply he understood human psychology and those timeless investing principles.
I think one of the things I really like about it is that he uses so many like real world examples to illustrate his points. Like that story about Sir Isaac Newton, the guy who basically invented physics.
Right.
Losing a fortune in the South Sea bubble.
Right.
If a genius like that can fall prey to market mania, it's just a good reminder that none of us are immune to those emotional traps.
Yeah, we all have those blind spots. And that's exactly why Graham, stresses the importance of having that solid investment philosophy, right?
Right.
A set of rules that you can rely on to guide your decisions even when your emotions are telling you to do something completely different.
And speaking of rules, one of Graham's big warnings was about investing in those second-grade bonds,
Right.
we now call junk bonds,
Mm-hmm.
he saw them as inherently risky,
Yeah.
and his advice just feels so relevant today.
Yeah, absolutely. I mean, just look at what happened with WorldCom, right? Back in the early 2000s, investors were lured in by those sky-high yields, but they ended up losing a fortune when the company collapsed.
Yeah, and that's just such a stark reminder that risk and reward, they go hand in hand.
They do.
If something sounds too good to be true, it probably is.
Probably. Yeah. And that's why, Graham emphasizes doing that thorough analysis. Don't just blindly follow the crowd or chase the latest hot stock. You really got to do your homework. You got to understand the company's financials, their business model, and really look at that competitive landscape.
It's almost like being a detective, not a gambler. Yeah.
Exactly. Yeah, you got to gather the clues, and once you've done your research, you found a company that really aligns with your investment goals. Graham's advice is to be patient and let the power of compounding work its magic.
So buy and hold.
Buy and hold, exactly. Don't get caught up in trying to time the market or make those quick trades. The research from Duke University, it shows that even those professional investors, they rarely succeed at that consistently.
So slow and steady wins the race.
You could say that. Graham believed that time was an investor's greatest ally.
And of course, diversification is key too.
Yeah.
We've talked about how important it is to spread your investments across different asset classes.
Absolutely. Don't put all your eggs in one basket, even if you're absolutely convinced that, a particular company is the next Amazon or Apple. Diversification, it helps to mitigate that risk.
It's about managing those ups and downs in the market,
Yeah.
which are inevitable.
Yeah, ups and downs, they're going to happen. And that brings us back to Graham's core definition of intelligent investing, right? It's not about getting rich quickly. It's about minimizing the risk of permanent loss
Hmm.
and achieving adequate, not extraordinary returns.
And it's just such a more, thoughtful and disciplined approach than what you often see, like in the financial media, which is obsessed with like short-term gains and the latest sensational headlines.
Right. Graham's approach is it's grounded in logic and that long-term perspective. It's about making those informed decisions based on facts, not emotions.
So, after this deep dive into the intelligent investor, what's the one piece of advice you would want to leave our listener with today?
I think the most important takeaway here is that intelligent investing, it's a journey of continuous learning. Stay curious, stay informed, and most importantly, stay focused on those long-term goals.
Those are words to live by, and I think Graham would be proud.
I think so too.
Well, thanks for joining me on this exploration of intelligent investing. It's been a great conversation.
Yeah, it really has. And to our listener out there, remember, the journey to financial well-being, it all starts with a single step. So keep learning, keep exploring, and most importantly, keep investing in yourself.